Hello bank fans, and welcome to Kinetic Training's Bank Risk videos. Today I'd like to talk a little bit about free banking. There's been a number of articles in the press recently questioning whether customers should be allowed to have free banking. After all, the banks are providing a service. Should we not be transparent and just charge for that? So thinking about this question a little bit, it's certainly true. I can go to my local branch, I can open an account, they'll give me a checkbook, a debit card, I can deposit money in cheques, I can use their ATM, I can set up direct debits and standing orders, I can receive payments, I can use 24/7 telephone support, I can visit the branch, and I can do my online banking. All for free, totally free, doesn't cost me a penny. Definitely I'm getting free banking. Or am I? Well, I know someone who can help us with this conundrum. It's Joni Mitchell. Joni, what do you have to say?
I've looked at love from both sides now.
Well, I'm sure you have, but we need to look at risk from both sides now. One of the things that really interests me about risk management problems is there are certain principles and ideas that can be applied across a wide range of situations. And this idea of looking at risk from both sides now is certainly one of them. The idea is that taking one perspective is not quite the same as if you step back and look at the whole picture. And I'm not talking cheap optical illusions here, rather I'm talking about bank balance sheet risk. So when we talked about free banking a moment ago, we were thinking from the point of view of the customer. Let's look at the other side now, the point of view of the bank. Here's a simplified bank balance sheet. Don't think the regulator would be too happy with this. No liquidity, no capital. But anyway, we'll ignore that for now. On one side, the bank takes deposits, and on the other side, it lends that money in form of mortgages and loans, and of course, it lends it at a higher rate than it will pay us on the deposits. And so in effect, the bank makes money out of our deposits. So it's not quite true to say that although we are getting free banking, that is a rough deal for the banks. Not really, because they make money in other ways. So this question of free banking, it really depends upon your perspective. From the customer's perspective, you pay nothing and you get a service, but from the bank's perspective, you can use the deposits in order to generate profit. So what's your opinion? Is there free banking or not? Why not leave a little comment on the Chartered Banker LinkedIn group? We would love to read them. Now, as I began to think about these issues and these questions, it reminded me of a previous financial crisis, and this happened in the mid to late 90s, not the 80s, I'm not that old, mid to late 90s, and this was when there was a hedge fund collapse. Most notably, Long-Term Capital Management, most famous hedge fund in the world, completely exploded and brought down with it quite a severe chunk of the hedge fund industry. Now, hedge funds, for those not familiar with the term, basically they're companies, they take a little bit of investment as capital, they borrow a lot of money, and then they trade it. And they're full of lots of clever people who hopefully will then be able to make you some money. When they became an important investment class, then of course all the investment analysts appeared. And what they soon discovered was, although hedge funds do tend to make a lot of money, they can be quite risky. And so the investment analysts worked out a little trick. Rather than investing in just one hedge fund, invest across a range of hedge funds. In this way you'd get equally good returns, but you would have lowered your risk. And indeed they were keen to prove this with some complicated mathematics, but in fact you don't need all that. My great-grandmother told me all about this. She wasn't a mathematician. She put it a bit more simply, and that was, don't put all your eggs in one basket. It makes sense to spread the risk. Well, this sounds perfectly reasonable, doesn't it? It sounds obvious, self-evident. Well, hold on, stop, warning, caution, danger. When something seems so self-evident, remember we have to look at risk from both sides now. If you don't know what the fallacy in that argument is, you might want to stop the video at this point and just have a little think about it. If you do know, maybe you've got a few grey hairs like me and you were working in the financial industry during that period, then let's just move on and discuss it. So here's what a hedge fund balance sheet looks like. On the one side they've got all the trades, and indeed here I agree that there was a lot of diversification across hedge funds. Indeed, some hedge funds would go long only in the market, some would go short only, some would do commodities, some would do interest rates, some would do equities. So you've got a very wide variety. However, on the liability side, all hedge funds were the same. They all borrowed short-term money. And when things start to go wrong, nobody is willing to lend short-term money to the hedge funds, and the whole system collapsed. So this idea of looking at things top down, looking at all sides, is very important and one that has been overlooked in many cases historically. So let's just have a quick recap. When thinking about risk, look at risk from both sides now. Look at the different ways of considering the risk. Also, don't be blinded by science. Just because complicated mathematics is used to prove something doesn't necessarily mean that it's going to be true. Well, it's very easy to criticise, I know, and it's fun too. But how do we improve this? Well, that brings me on to Bankworld. This is a bank risk simulator that we will be running in conjunction with the Chartered Institute of Bankers come this autumn, and it will allow you to experience exactly these risk management problems. You'll be able to run your own bank, and within each bank you can make a wide range of management decisions, including things like setting deposit rates and mortgage rates, i.e. working on both sides of the balance sheet. And you'll do this in competition with other teams aiming to get market share and to become the most profitable bank. I'd love to have you join us in that simulation. As I say, it'll be happening in the autumn, so keep a lookout for further information. My name's Keith Thruxton from Kinetic Training. Hope you enjoyed this video, and we'd love to hear your ideas. Why don't pop a comment on the Chartered Banker group in LinkedIn. Thanks very much. Bye bye now.